I'm Greg Thomas, Managing Director of 375 Park Associates, and welcome to this week's edition of Insight at 375 Park, where we help business buyers, investors, and deal makers stay ahead of M&A trends, financing shifts, and strategic risks. Today, we're looking at the end of globalization, how the China Plus One strategy has collapsed, why nearshoring is now a strategic imperative, and the hidden risks that could reshape everything in 2025. Well, let's dive in. Well, it's been a busy week, and the recent announcements should not have come as a surprise as Trump ran on a promise to impose tariffs. With the Liberation Day announcements, one thing is clear: globalization, as we know it, is ending. But in many ways, global trade has been slowing for some time. In fact, global trade as a share of world GDP has plateaued since the Great Recession. Meanwhile, the United States remains the world's key consumer market, the one place where imports continued to grow. But last week's announcements will alter the face of trade. In this new environment, the companies that win will be those that move fast, de-risk supply chains, and build production networks closer to their customers. Globalization is ending, and the smart players are already repositioning. So the China Plus One strategy, that is shifting production into Southeast Asia, was built on the assumption of stability. But if tariffs hold, and that's a big if given Trump's capricious nature, the playbook is effectively dead. The U.S. is no longer just targeting China, it's challenging globalized production itself. The good news: organizations that pivoted during the pandemic already know how to move. This time it's relocating into the USMCA zone, Mexico, the US, and Canada, or selected parts of Central and South America. If you haven't started yet, you're already behind. What's the message? Nearshoring is no longer optional. From a US perspective, Mexico and Central America are critical to building resilient supply chains. But these transitions take time. Build facilities, qualifying suppliers, securing labor. Best case, it's a 12 to 36 month process. What's the smart strategy? Implement in stages. Dual source key components now. Pilot local production and scale gradually. Companies that start today will be positioned to win as supply chains realign. Companies that act now, locking down suppliers, reshoring critical inputs, and securing logistics partners, will lead. Early movers will lock in lower costs before the next inflation wave, capture market share while competitors scramble, and set the pace for the next decade of growth. Here is some tangible advice. Audit your supply chain now. Renegotiate terms and prioritize regional sourcing. Move first, and the advantage is yours. But let's be clear. Tariffs alone will not rebuild American industry. Today, American companies, employees, and households are being let down by Washington's failure to move beyond slogans. What's missing? Clear tax reform to support investment, lower interest rates to unlock capital, zoning and regulatory streamlining to accelerate projects. Until policymakers deliver real support, businesses are left navigating massive uncertainty alone, and will all have to pay the price in slower growth and higher volatility. Whether this new round of tariffs sparks a true real industrialization or drives the U.S. economy towards stagnation and crisis depends entirely on what Washington does next. Let's get this straight. I have no idea what will happen at the opening bell, but indications are that the markets are in a free fall as they scramble to reprice a seismic shift, and volatility is just getting started. If you're considering acquiring any company with a heavy China or Asia supply chain exposure, stop and rethink. You may need to renegotiate, or you may need to walk away. Sellers, you must recalibrate your expectations now unless you can rapidly lower your tariff exposure. Supply chain risk is now a valuation risk. Ignore the daily noise from the stock market. This isn't about short-term swings. It's about long-term survival. Focus on the fundamentals. Who controls the supply chain? Who can adapt fastest? Who can protect margins under new trade realities. Get this wrong, and you could buy hidden liabilities that sink your investment. Get it right, and you'll be positioned to win as the chaos clears. Beyond tariffs and supply chains, a bigger threat looms: the debt trap. Trillions in U.S. government debt and commercial real estate loans are coming due, much of it borrowed when rates were 100 to 200 basis points lower. Without lower rates, refinancing becomes brutal. Defaults will rise, and capital will dry up across the economy. For deal makers, this means liquidity tightens, valuation swings sharply, timing becomes critical. Plan now, move strategically. Waiting for full clarity could cost you the window. So let's recap. Globalization is winding down. The China plus one strategy is dead, at least for now. Nearshoring is a must. Early movers will win, and government action is long overdue. Finally, the debt trap is real and it is urgent. Lower rates, even modest ones, would give businesses and government breathing room to invest in supply chain resiliency and reindustrialization. But it won't be easy. Those who act now, those who build resilient supply chains, rethink acquisitions, and structure deals for volatility will be the winners in this new era. Deal makers, this is a critical moment. The global order is shifting under our feet, and the playbook no longer applies. If you're buying, rethink deals with Asia-heavy supply chains. If you're selling, recalibrate expectations now. If you're operating, secure and control your supply chains fast. At 375 Park Associates, we help clients move decisively so they can seize opportunities while others freeze. Let's talk.